Joining us right now is Bob Diamond. He's the CEO of Atlas Merchant Capital, former CEO of Barclays. We're all trying to figure out which way the wind is blowing. Which way is it blowing?
I think the biggest
sailor, right?
Yeah, the biggest thing about the markets right now is I think they've adjusted to higher rates. You know, that we went through this really long period where the debate every time was, you know, what's the rate increase? How far are they going to go? And you know, you saw the collapse of SVB, which is a lot about higher rates. And I think right now people are kind of relaxed that they know where rates are.
Should they be, though? I don't know if you saw, Ken Griffin was on our air just yesterday, and he made the comment that it was nerve-wracking to see that actually rates had moved as high as they had, and that actually stocks had held up, and that was sort of such an unusual situation that he was a little bit anxious about where that goes next.
I don't think it's unusual, Andrew. I think, you know, from 2008, when we had the financial crisis, to 2019, Fed funds actually averaged less than 1%. That's not normal. I think this is far more normal. You know, the period before that, Fed funds averaged something like 4%. Now they're 5.5%. I mean, I think this is more normal than zero interest rates for 10, 12, 14 years.
Okay, so we just heard from Bill Rudin. He was talking about commercial real estate. And, you know, there are some areas of the market where there's this big assumption that rates are going to come down pretty significantly next year, maybe 100 basis points. His point is if that doesn't happen, you're going to see more problems with commercial real estate as you have all of these loans that come due and won't be able to be refinanced at a price that can make it work for them. Do you think that's a problem, or is that just a problem for the people who actually own these buildings?
Yeah,
and there's plenty of other money that will take it over.
What I feel confident about, Becky, is there's very little chance that rates are going to come down. I think if you go back through history with Fed decisions, to pause is kind of a normal process. And I think the Fed is in the process of pausing. Maybe there's another 25 basis points somewhere. But to actually reverse course is a very, very high bar. And I think for this Fed, having gone through what they went through with 9% raging inflation, they were part of the cause of that. In recognizing they had to do something, they're going to, I mean, for choice, they're going to stay too long, not exit too quickly. And I think a pause is here. But I think if we have expectations for cutting rates next year, I think the bar is very, very high.
So you got China, right? Although maybe they're getting a little better. I think maybe there's some light at the end of the tunnel. I have a question about oil prices globally above $90. What if they stay above $90 globally? Does that make the Fed's job easier because it's a global tax and it is a damper on global growth? Or does it spread into prices where they have to be even tougher? Now I'm starting to think that it's going to do the work for the Fed by damping. You're a hawk. You're very hawkish right now, and you think we're going to stay 2024, no cuts whatsoever, is what you're thinking.
I wouldn't say I'm hawkish. I think the economy is adjusting
you're old
to
and you're like
rates.
me, and you think 8%, 10 years normal.
Yeah, that'd be nice,
That's what you think, right? And I understand that.
That's what Leon Cooperman
for years, I just can't believe. Businesses can do fine at 8%. You know what I mean? There needs to be a cost of money, and zero is not what the cost of money was. So somewhere between 0 and 8% is probably right, and you figure we're right there right now.
I'm not in the camp that they have to go higher. I'm really not. I think this is a time to pause.
This is the new normal.
But I think getting back to a more normal world, listen, I think we're still going to see more problems going forward because we had 12 years of free money, and that just creates issues. I go back to the issues at SVB. They were all around that asset liability match, right? Yeah. They didn't adjust quickly enough. Now that the economy has adjusted, I believe we're in a more normal situation.
What's oil doing? So that's on the Fed's radar screen as more hikes, not that it does a job for them.
I mean, a lot of the oil prices, as you know, is a geopolitical issue, and that's really hard to predict.
It's still going to hit. It's still going to be $4 a gallon gas. People aren't going to do as much as they wanted to do before that. People need to buy food.
Yeah.
Bob, you keep mentioning SVB, and I want to just go back to, I remember when that happened, one of the things that we talked a lot about together on this broadcast was what was going to happen to the regional banks, what was going to happen to all the real estate, both multifamily but more particularly, corporate real estate, office and the like. And given that you're in the business of trying to buy things on the cheap, are you seeing or thinking, I think at the time you thought, come the end of this year, it's 24, 25, when things start to roll, that all of a sudden there might be opportunity in your world. Do you still see that being the case? Because opportunity for you is, by the way, a problem for others.
Sure. I mean, we're in the business of putting private capital into financial services primarily, and we do see regional banks as a great opportunity over time. I think getting private capital in there. But would I like to see a little bit of a higher deposit guarantee? I'd like to see it. I'm not sure it's coming soon. But I do believe that one of the strengths of our economy is the depth of our financial markets. It's incredible, the capital markets. Look what it's done with the ARM listing, right? I mean, has there ever been a better advertisement for the depth and diversity and liquidity in the U.S. capital markets than, a British chip maker coming to the NASDAQ and the success of it?
And saying maybe someday we'll do the LSE. Not today, but maybe someday.
We have a huge competitive advantage here in the U.S., and it's not just the NASDAQ and the New York Stock Exchange. Think of the investors that took part in that. Think of the pricing. I mean, it's at the high end of the range, then it trades up 20-odd%, and just the depth of the capital markets here relative to the UK.
Okay.
I don't think it's something they can match.